Hi, in today's video we'll take a look at indicators for ranging and trending markets. As you might know, the price patterns in these market types are quite different, so we have to use different types of indicators too. Let me show you what I mean. First of all, please do remember that we don't provide any investment advice and all the material is made available for educational and marketing purposes only. And please remember to subscribe to the channel. That would be a great help. Thank you. Okay, the first trend indicator I want to talk to you about is called Parabolic SAR. The name of the indicator comes from stop and reverse, so it's called parabolic stop and reverse, and it refers to a trading style where you don't go into cash between the trades, but when you are long, you reverse your position and go short. And then obviously when you're short and you reverse your position, you go long. So no going into cash in between. So that's the original idea of this indicator. So how do we use parabolic SAR? First of all, you can find the indicator if you go to insert indicators trend, and there you will find the indicator. So I'm not touching the settings here, I'm just using them as they are. So let's look at how you can use this in your trading. First of all, you might notice that when the market is moving higher, you have these dots below the market price or below the price. So the usefulness of this comes from, it kind of gives you the direction, it gives you the idea where the market is going, and especially because the market is moving above a moving average, then we should think that the market, for this reason alone, we should think that the market is going higher. But then the parabolic SAR gives you further confirmation by displaying more dots below the price and only few dots above the price. So the way you can use this is you look for long positions when you see this happening. So first of all, the price is above the moving average. You could also pay attention to the fact that moving average is pointing to the upside, and also that most of the dots in parabolic SAR are below the price. So then you look for long opportunities, and obviously you can have several different strategies in this up move. You can buy the breakouts, you can buy the retracements, whichever style is good for you. But to stick with this indicator, the idea is that we stay long as we have the market moving higher above the moving average and the SAR, and the dots are below. Then here comes a point where we start to have more dots on the upside. So this is where the market might be kind of losing its momentum. That's the indication here. And in fact, now that we can see it after the fact, the market lost quite a bit of momentum and started moving sideways. But if this was the hard right edge of the market, right here, we wouldn't be able to see the future, so to speak, and we would just have to rely on our observations. And the indicator, now the indicator here is giving us the indication. It's not a prediction, it's only an indication, but it's still something, it's better than nothing. So it gives us a tool to work with. And here the message from the indicator is that the market has lost momentum. It's not moving higher as strongly as it was moving before, and it might actually turn to the downside or move sideways. So that's one way of using this indicator. Another way of using this is that when the market is moving sideways, and it kind of, I'm going to use horizontal lines here to highlight where we can say that the market has established a sideways range. 1, 2, 3 touches in this area, and gold wasn't able to move higher than this. This is hourly chart in gold. Then the market retraces lower, and here we have I think it's safe to say that after 2 touches here and one touch here, and then a rally to the same level, now we have a range established. Once the movement from that resistance is kind of, confirms that there is no demand for this market above this level at this time of in this point of time. Now, from this point onwards, we look at the message from the SAR, and here it's still giving us a long indication. And yes, there was a little rally higher, but I think what's more important is that when the market rallies a bit, here over this period, when the market does move lower, there was an indication that this is what should happen. And as you, I'm sure by this time, know that in a trend you want to be a buyer at the lower end of the range and seller at the upper end of the range. Therefore, you could play this by selling small rallies up here or inside this down move, and then buying back close to this support. Then we see that the indicator starts to create dots below the price. So from that point of onwards, it's suggesting that we don't probably have downside movement anymore. It's more likely to be upside movement. Okay, it kind of fails here. It really, price just moves sideways and nothing much happens. This highlights a very important fact about the markets and indicators. No indicator is perfect. So we just have to make do with this imperfect world of indicators giving us wrong signals or wrong indicators every now and then. And that's why we need to have risk management in place. Never trade without stops. Then we have price moving lower. The dots of the SAR are above the price. And then comes the big move to the upside. And from this point onwards, you have market staging quite a big up move. And the Parabolic SAR highlights this by plotting these dots below the price. So whatever trading rules that you create using this indicator, if you just follow those, and assuming they are sort of reasonably good trading rules, if you just follow your system systematically, then you are bound to get these big moves every now and then. And when the market isn't quite moving well, then you just get stopped out. So what does it matter if you lose 1 or 2% here, but then you make 10% up there? See my point? Yeah, okay. And the same obviously applies here. You might lose something earlier here when the market is chopping, and then it starts to move strongly higher. You catch the trend and you make more money than you lost here. So that's the idea of trading. So that's the introduction to Parabolic SAR. I strongly encourage you to go and study the charts, go and study the previous historical data and previous price action in those charts, and then you will be much more well prepared. You'll be in a stronger position to actually create something meaningful in terms of a trading strategy. The next set of indicators I want to talk to you about, they are based on moving averages. So first of all, I have 2 moving averages here to point the trending periods. It's a setup, very common setup, where you can have a shorter period moving average and a longer period. I have a 20 period and 50 period moving averages on orange and red respectively. And when you have the price shooting higher, it's very common that the indicators move below the market price. They are pointing higher, and the faster moving average is above the slower. So when you have this setup, you shouldn't be looking for shorts, even though eventually in this situation here, there was a dramatic move lower. But you can't, if you think about trading in terms of your next 10,000 trades, then you want to have something that is repeatable, something that happens over and over again. You can't focus on the outcome of this one single trade. Otherwise, you'll just end up chasing something that happens very rarely, and most of the time you lose money. So you have to have a strategy that often is correct and rarely isn't. So that's the idea. Don't try to be a hero and short the market when it's trending higher. Then later on, we have a situation here where the market is just chopping sideways. The moving averages are kind of all over the place. So obviously there's no trend. The market swings about around the moving averages, identifying that signifying that we have a sideways move, a range here in Dow Jones. Later on, as we move forward, the market breaks out of this sideways move. There aren't many certainties in the markets, but this is one of those. Every trade range or the market range is broken out of. The markets will always break out. And then there will be often trends, and you can take advantage of those trends if you use the moving averages correctly. Again, we have shorter period, the 20 period moving average below, and the 50 period, the slower moving average above. And the price is moving down here. Okay, so we have shorting opportunities here, but how do you take advantage of this? And this is why, and I want to introduce you to something called envelopes. I'm adding the envelopes here, and we just happen to have period settings at 20 and deviation of 50. So in a moment you'll see how this indicator works, but I want to just briefly mention that the idea is that we have two bands, a little bit like in Bollinger Bands, but slightly different though. We have two bands above and below. So one band above, one band below the moving average. And the deviation number here is a percentage. So what I have done here is I have set the deviation 0.5 percentage point above and below the moving average. And this is how it looks like. Now we have the 20 period moving average here from the before, and then the two bands at 0.5% distance from the moving average. The big trend is here, the 50 period moving average. And now we have something that helps us to decide where we want to be sellers. There's at least a couple of options here. When you see the market breaking below the lower band, you have a break below the recent lows as well, very often. So you could create a rule where you say that, okay, I'm interested in breakouts in a downtrending market. So there's your support, and here we have market breaking below the lower band and then moving below the lower band. So that's a very that's a weak market. There aren't many buyers here. Then the market moves back inside the bands, and now it's kind of just chopping, moving sideways. So what do you do in sideways movements? You sell the upper band, you buy the lower band until there's a break below this range again. Here we have market, every trend is over at some stage, but that's the way the trading is like. You can't have a perfect world. But here we have something similar like up there. The market breaks below the recent low. It's trading outside the lower band, so it's very weak here until it moves back inside the bands, and then we can conclude that the trend is over. If we go backwards a little bit, we can see this uptrend example here. This is slightly different, and it's a good reminder again that the markets always change. They're never the same, but you can classify different uptrends and different downtrends, and you can find ways to execute your trades profitably if you just study the markets well enough and understand what's going on and have different rules for different market environments. Here we have the market moving higher, but this time the market is fluctuating slightly above, slightly below the upper band, but it's still staying above the moving average. So this is a signal of strength to us. Here we had some movement between the middle band and the lower band, and the market wasn't quite sure what to do. Once it found its sort of steady uptrend between the upper band and the middle band, the moving average and the upper band, there was lots of opportunities to participate this uptrend. So again, go and study historical price charts and find ways to use this indicator in such a way that it fits your personality. Maybe you find something that I didn't notice here. Maybe you find a new edge in the market if you do enough studies with historical prices. Hope this helps, and if you have any questions, email us on support@TIOmarkets.com. Okay, the next indicator we're going to cover is called MACD, or Moving Average Convergence Divergence Indicator. And it's made up of 2 lines and a histogram. The histogram, the grayed area here, isn't that important in this kind of analysis because we're using the MACD here as a trend indicator. It's a little sort of unorthodox way of using this indicator, but you can see that it is quite an interesting tool for this purpose also. So let's forget the histogram here and focus on these 2 lines. The blue line is what's known as an MACD line. And if we right click on the indicator, we get the settings window up. And here I have a couple of moving averages that basically define this blue line. The thin blue line here, actually. Anyway, 100 periods and 50 period moving averages, they tend to move away from each other when the market is moving strongly higher, and they tend to move closer to each other when the market starts to lose momentum. And the same applies to the bear markets also, the down markets. Now, let's look at the price chart here. If the market is moving higher, like here, we have the blue line moving higher as well. That indicates that the distance between the 2 moving averages is increasing. Then when the market starts to move lower, the moving average difference decreases, and then obviously we get the blue line moving to downside. So the blue line kind of tells us that the momentum is not there anymore. But when we have this setup where the blue line is above the red line, then we have a trend indication in this market. So from this point onwards to this point up here, DAX is in this time frame, the hourly time frame, trending higher. Then the trend is over, the market starts to move, it kind of drifts lower, and then at some stage here, the blue line crosses above the red signal line, and then from this point onwards all the way up here, as per this indicator, the market is trending higher. So this allows you to look for buying opportunities up here. Just like here, just don't try to short against rising prices. It's better to go with the flow. Then in downtrends, we can use the same idea. Here we have the blue line crossing below the red line. And from this point on, because the blue line moves lower, we know that the difference between the moving averages is growing, so that's bearish in this context. Then later on, the market starts to move sideways, and what happens? The blue line comes very close to the red line, indicating that there is not much momentum. It basically is indicating that the fast and slow moving averages are fairly close together, the 50 period and 100 period. And then eventually there's a crossover. So from this point on, like we earlier noticed, from this point on here, the market is bullish and moves higher. So that's how you can use the MACD indicator as a trend indicator instead of sort of mean reversion indicator for ranges. Here we have RSI, Relative Strength Index oscillator on blue here. It's basically a misnomer. There's nothing to do with relative strength here. This isn't measuring the strength of this market relative to any other market as we usually talk about relative strength. But with the name aside, here's how the indicator works. And it works the best in ranging markets because it's an oscillator that again fluctuates between 0 and 100. So this indicator has two areas where we talk about the market being overbought or oversold. When the indicator is below 30, that's when we say that the market is oversold. And that's there's some truth to it. When the market is trending sideways, it tends to bounce higher when it ranges sideways and hits a support. And what this indicator does, it shows or highlights those points to you. Then there's the area of say the indicator is above 70, and that's where the market is thought to be overbought. So the market is moving close to resistance levels, and the indicator highlights that by being above 70. So let's take a look at some examples here. First of all, here we have indicator moving to 70. I'm actually going to bring up a data window here that helps us to see what the values are here. So when the blue line crosses above the orange line here, the RSI value is 72.62, and that is a sell signal when you are using an oscillator like RSI. Some people prefer to have a confirmation, and then that would mean that you only enter the market when you have a down candle or when there's a lower indicator value coming down from the overbought levels. So you would sell down here. The problem here is that you've just lost about 15 to 17 pips of potential profit when the market is ranging sideways in a fairly tight range of about 42 pips. So almost half of that range width, which is really your profit potential, has been lost by waiting for the indicator to come down. So the better way of trading this is to have your entries where the indicator moves above 70. Obviously, this is not investment advice, and you need to go and study the historical charts to make sure that this is the case and it's working for you. So don't just rush to trading something like this based on something that you saw on a video. Markets change, they are different, and you might read the market differently, and there are different times. Sometimes the ranges like this are fairly tight and sometimes they're wide, so you need to wait for the market to establish the range first and see how volatile the range is and where the likely resistance levels are. And if the RSI actually provides value in that range, you might want to wait for a little while and only then start executing trades based on the RSI. That's how you can use RSI in your trading. Again, if you have any questions about indicators or trading, send us an email to support@tiomarkets.com. And if you have a question specifically to me, ask them to send it to me, and I will make sure I answer your email either in a video or in an article, because I want to help the answer. I want the answer to help all the traders that read our material. This indicator is called momentum. It basically measures the distance between the price point now and the price point 10 periods ago, or any other period settings. You can go into these settings, right click and choose whichever you want to. I'm just using 10 for the demonstration purposes here. So basically it measures the movement over this period of time. So 10 bars, if you change this to 20, it means that it measures the price change over 20 bars. But let's keep it at 10. And now, one of the ways you can use this is to highlight momentum changes. As you can see here, this high and this high, they are almost identical. Maybe that's even a little higher. But if we look at the momentum indicator, we can see that the latter point is actually quite a bit lower. So it's quite a bit lower actually, yeah. So here we could use the arrow to highlight that there is divergence. And divergence like this, usually, especially in ranging markets, indicates that there is no more upside momentum, so the price should move lower. Here in this situation it moved sideways quite a bit and then moved lower. Now this slow price movement here is from the Asian session, but then comes the next European session and there is more price action here. So the same divergence is here again. You can see how this high is lower than the high after it, but if you look at the momentum indicator, you get a divergence. There's lower high when the market makes a higher high. So once again, the indication is that the market might be losing momentum, and if you see that happening after that, if you see confirmation in the price action, then you might consider taking short trades. And obviously it's up to you whether you want to sell the rallies or whether you are more comfortable selling when the market breaks down. So that's the way you can use a momentum indicator. But also, if you want to use it as a highlight of direction change in the market, let's use a trend line here to measure this downtrend, the highest high and then a reactionary high. And after the price has broken above this trend line, that downtrend isn't in force anymore, but the price is ready to move higher. Let's see what the momentum indicator gives us if we study the 10 period momentum here. I'm going to make this a little bigger now, and I'm going to do the same analysis here in the momentum indicator. And we take the highest high and the reactionary high, and let's see if we get any benefit from doing this. It seems like there is a much clearer indication, at least one bar before, that the market is changing direction. In the price itself, we have a break above the downtrend line here on this candle. But if we look at the trend line drawn on the momentum line, then we have a break above the trend line actually on this candle. Not much of a benefit there in terms of the price, but you get maybe a clearer indication that yes, the market might be changing its direction. And so here are some of the ways that you can consider using this indicator. Some people use this to find breakout opportunities as well. And obviously, if you're trending in a range, that might not be so relevant, but at least in this occasion here, we had price breaking higher, and there was a very clear bullish, small but clear bullish wedge in the momentum indicator, and then the indication to buy the market came on this candle. No, there wasn't much of a signal in the price chart itself at the time, but the momentum indicators pointed to this opportunity already down here. Then the market moved quite a bit. But the overall context here, if we look at this price action, the overall context was kind of a range. The market wasn't trending very clearly to any direction. So here are a couple of ways that you can study and then probably use this indicator in your own trading. Just make sure that it works for you and you know what you're doing, and then you can start applying it in your trading strategies if it sort of fits to your personality and your trading style. Thanks for watching the video. Stay tuned by subscribing to the channel and switch on those alerts so that you get to know when we publish new videos. And really, I look forward to seeing you soon on the next video. If you have any questions, please email us on support@TIOmarkets.com and we'll be happy to answer any trading questions that you might have.